Hello, hello, hello. Thanks everyone for tuning in. If you get the chance, just ping me in the chat. Let me know that audio is coming through okay, and then we'll get started in a couple of minutes. While we're here, why don't you let me know where you're all coming in from, whereabouts in the world you all are. We usually get a pretty good cross section of people here, so it's good to see where people are coming from. For those of you who don't know me, my name's Checkmate, and I work with Doc and Mav specifically on the fundamental analysis side of the crypto space, and in particular, my focus is on-chain analytics, and really Bitcoin is the pinnacle of fractals and things we can pull out of it. It's a truly fascinating digital organism to study. So today what we're going to be talking about is a class on energy money. So we're going to be looking at everything to do with proof of work, some of the fundamentals, and really exploring what that means for this protocol. This is great. People from the USA, Denver, Utah, Lisbon, Colorado, Sudan, Zimbabwe, Netherlands. Great to see you guys. Ohio, Mexico, Romania, UK. Tidy work. All right, so what I like to do at the start of these things is make sure I give good credit to the people who put a lot of work into this, and this is my small part to give back on some of the things that I study and see. So first up, talking Dan Held's done some great work on looking at Bitcoin security mechanism, in particular proof of work, and how this thing's going to play out over time. Willy Woo's done some great work looking at difficulty ribbons and all sorts of on-chain metrics, and really is he's done an incredible amount of work for the space. Hans Haig's done some excellent work on looking at hash rate, difficulty, and regression. And there's a great piece of work by University of Cambridge looking at the electricity consumption index, which is something that we'll refer to later in this piece. So hope you enjoy, and we'll kick this thing off. So starting up, Bitcoin is a form of energy money, and there's a couple of principles that we'll kind of start with and use as the backbone for this module and understanding. So the first one was a quote by Ralph Merkle, who invented the Merkle tree, which gets used quite extensively in the case of cryptocurrencies. And Bitcoin is an organism that lives and breathes on the internet. It lives because people can pay it to keep it alive, and it lives because it performs a useful function that we are willing to pay it to perform. And there's another great quote, Albert Einstein: energy cannot be created or destroyed, it's only changed from one form to another. And what we're going to look at here is how Bitcoin is probably the most pure form of energy money. Energy is a fundamental commodity of the universe, and it acts in a very interesting way in distilling that energy down into arguably a currency that we all can base on that fundamental commodity. So that's what we're going to be exploring in this class. So a quick introduction and disclaimer. So this is the fourth module in this series of modules. I'm continuing to build certain things, depends on what piques my interest, but the first one was on the realized cap and understanding the difference between that and the market cap. We looked at modeling value with scarcity, so based on some of the work by Plan B. And last time we did the NVT and the RVT ratio, looking at transaction flows and how we can use that to really price and understand more about this digital organism. So the fun part, the disclaimer: nothing is financial advice. This is purely my opinion and research, but it's certainly something that I like to share with you guys to help pique your interest and get you thinking about things. I really am just a dude on the internet, so really take this as information only. And if you do your own research and you use these tools and this open source information web that's out there, you'll be able to make much better decisions in your how you look at these networks and how you develop your own mental models for them. So always do your own research, and that will by far be the best piece of advice that I can possibly give you is understand these things for yourself and build your own mental model, and everyone will have their own version of that. So what we're going to talk about today, we'll look at an overview of distributed proof of work and why it is a fairly special consensus mechanism, and arguably one of the the major breakthroughs that the Bitcoin protocol did. We're going to look at miner income and the incentive model and how that plays into it. It's an economic industry, really. We're going to talk about Bitcoin as energy money and how it is that distillation of energy down into a form of currency. We're going to look at a piece of work that Willy Woo did on the difficulty ribbon and how we can use it to pick areas where you've got, zones of compression and where miners capitulate, looking at miners as a participant in this network. Some of the work that Hans Hages did on hash rate and regression models, and then what the future of mining looks like, and where we can kind of see this going and evolving over the years. So, proof of work. Proof of work is the novel consensus mechanism that Bitcoin employs. And what it does is incentivize security and finality of the blockchain. So miners effectively compete by performing computations to guess a hash. And really that's just to solve a complex cryptographic puzzle that the algorithm or the protocol sets. And it's only when you actually have this correct hash, which is effectively a proof of expended energy, that a block is actually mined. So the miner that actually comes up with this hash first settles the next block and effectively fills it with all of the transactions that were paying the highest fee at the time from the mempool, and they then get written to the ledger. And that's what we get when you get your first confirmation. So what the proof of work system does is it effectively serves three primary functions. The first one is that it's the incentive mechanism. It's the mechanism by which Bitcoins are actually distributed to those who provide that security in the form of work. It routes the cost of security to attack and really disrupt the Bitcoin network to the laws of physics. You must consume energy, and this effectively reduces the spam and makes any form of attack very expensive. And the third one it does is it builds a digital wall of protection around confirmed transactions that can only be brought down by redoing past work. And this is really what gives it that immutability perspective. You must overcome all of the previous proof of work that's been done in order to erase or change history. So with each new block that gets minted, all the past transactions are effectively locked under an increasing weight of energy spend, which is what we call confirmation. So every 10 minutes, that layer of amber around your last transaction gets thicker and thicker and thicker. And in the end, the longest chain will win because this work is cumulative, and in order to rewrite that history, the attacker has to not only compete with the friendly miners on the current block, but they also need to be competing to redo past work. So even though we talk about 51% attacks, the reality is in order to be genuinely successful and redo the history of what's been locked in, you actually need to have way more than 51%, because otherwise you'll be attacking the chain for a very, very long time and expending an extraordinary amount of energy with very little to show for it. So we call it a 51% attack, but that's really more of a technicality than a reality. It actually has to be much higher than that to be truly successful. So we'll talk through a little bit of an example. So if we assume that we've got block n-1, and at the moment we've got friendly miners that are currently plugging away at that, solving that particular block, and then once they've solved that block, they're going to move on to the next block, block n. So at the same time as that happens, you get an attacking group of miners who come in, and what they're aiming to do is reorganize block n-1 that was recently just confirmed. So they're going to start attacking on that chain, and they're going to start mining what is effectively a second chain. And you've got a little chart at the top here where it's shown that the friendly miners have proven and locked in that first block, n-1. You've got block n that they're both competing on. Let's assume that they both solve a block. Now, attacking miners can do this in secret or any other method, but you effectively get a chain split here. Both these chains are the same length. They're both at the same block height, but you have two different sets of miners working on them. Now, because the attacking miners want to rewrite block n-1, which is that first block that we had confirmed, they actually now need to split their hash power to mine block n+1, so they're both mining the current block, although the entire hash pool of the friendly miners are currently working on block n+1. The attacking miners have to actually split their energy and attack both n-1 to reorganize that and get to the transaction that they wanted to change at the same time as they're attacking block n+1. And you can see now why you actually need more than 51% attack to have a very, very strong chance at taking down block n-1 doing a reorganization. There's small reorgs that happen all the time in the Bitcoin network because there's still transactions and information flowing across a distributed network, but they tend to get sorted out fairly quickly and fairly naturally. They are actually a natural phenomenon. But if we have a case where you've got an attacking miner, they really have to split their hash power, and therefore 51% really won't cut it to make a great deal of difference. Because if they don't have enough attacking power to actually take on and create a longest chain, the friendly miners will effectively build a longer chain. They'll start mining block n+2 before the attacking miners have solved n+2, and therefore the friendly miners now have the longest chain. So they have to actually compete with the current friendly miners as well as attack the previous block. And once that fails, all of that attacking work is rejected. The green bars here show that the friendly miners effectively win those blocks, and all of that expended energy in the attack is effectively wasted, and that has a heavy expense. So if they were to win in this instance, that's where you get a scenario where you get a reorganization. But you can very quickly see how much power, how much effort, and how much time and electricity that's going to take, because you have to completely overrun all of the friendly miners. So that's the fundamental basis for how proof of work is structured, and why it provides such a very strong incentive and cost barrier to changing transactions. So mining Bitcoin is a permissionless system, and this is critically important. Anyone who chooses to commit computational power is able to participate. There's no way that any cartel or group of other miners can prevent somebody else from jumping on the chain and starting that mining process. There is no mechanism, not even 100% of miners can stop someone else from coming online. So this is a significant advantage of proof of work over any other competing consensus rule, because in other consensus rules, you can have a scenario where a cartel can actually fork the chain and move it off in a different direction if they don't like a particular party participating. You cannot do that in proof of work. And that's why we lead to distributed proof of work. And you get miners separated all around the world, and you end up with the benefits of geographical and jurisdictional diversity of those miners. So if we go through a brief history of proof of work, it's gone on Bitcoin specifically. It's gone through 4 very distinct phases. So in the early days, it was all CPUs, and this is back in the days of Hal Finney and Nakamoto himself. And this really only lasted shorter than a year. And it was really just cypherpunks and hobbyists who were involved mining off just typical computers. It then moved to the GPU phase. And the reason GPUs are more effective is because a CPU does multitask, does lots of things. A GPU does one thing very well, and that's graphics. So it's a lot more of a dedicated system. It's designed to do one particular task exceptionally well. And this started to move into the hobbyists and some early scale, but not significant. And then there was a period called the FPGA, or Field Programmable Gate Arrays. And this is kind of like a pre-ASIC. So this was a device that could be programmed to do something specifically, but it was not designed to only do that task. So you could reprogram these FPGAs to do any specific task, but they weren't specifically designed for Bitcoin. And this is where we started to see some real industrial scale move into the space, and that ran through to about early 2014. And the current phase that we're in, which is arguably the most important series to get to for a proof of work coin, is into the ASIC phase. And ASICs are actually extremely important for the game theory of a proof of work network, because these machines are built and they do absolutely nothing but mine that protocol. They cannot do anything else. They're a very expensive paperweight otherwise. So what this means is that miners, when they invest in this, and this is where we start to move into the industrial scale and really institutionalized type mining operations, when you buy a suite of ASICs, you are committing to protecting the chain, because if you want to protect your investment, you need to mine that chain in a friendly manner, because attacking it will effectively nullify your income stream. And miners are investing hundreds of millions of dollars in this equipment, plus energy contracts for a long period of time. And really, ASICs are an important stage. So for a proof of work chain to progress through these phases and finally get to ASICs, particularly now that we're all aware of cryptocurrencies and attacks are far more common, it's almost like a coming of age story when you finally get to ASICs. And the value there is that miners are committed to your chain. The challenge with GPUs and FPGAs is that it's hard to maintain loyalty. Really, if you've got a GPU farm, you can move to whatever the most profitable chain is. You don't necessarily have any loyalty. So this is why that coming of age into ASICs is a crucially important step for any proof of work project. And you can see here, this is just a plot of the difficulty adjustment in blue and the hash rate in orange, and then the price in white. You can see the different phases from the CPU through the GPU and then into ASICs. And bearing in mind that this is on log scale, so this is a tenfold increase for every single horizontal bar. Effectively, hash rate and difficulty for Bitcoin have been in a constant 10-year uptrend for its entire history. So it consistently grows, and the network security on Bitcoin is unbelievably strong and continues to get stronger. So we'll talk about the mechanics of that in a short time. And you can see that there is a fundamental relationship here between price and difficulty and the number of miners who are actually participating in security. And we'll explore what that mechanism actually is. Is it price that drives hash rate, or is it the other way around? So we can look at the Bitcoin economic model. At the core of the proof of work system is an ingenious function called the difficulty adjustment. And this is so important to understand to really gain an insight into the game theory behind mining and why it's such an ingenious part of this whole system. So what the difficulty adjustment is Bitcoin dynamically adjusts the complexity of the cryptographic problem every roughly 14 days or 2016 blocks. So what that does means no matter how much hash power you throw at the particular puzzle, every 14 days, if you have a stack more miners come online, the problem that they need to solve gets more difficult. So the more miners and the more hash rate that comes onto the network, the more difficult the puzzle. And likewise, the more miners capitulate and leave the market, the difficulty level reduces. So that means that the issuance of Bitcoins remains deterministic. We still target that 10-minute block time because as the puzzle gets harder, it means more miners are on the network. As the puzzle gets weaker, it means less miners are on the network. So for the same amount of hash rate, or an increased hash rate, or a lower hash rate, you will get the exact same deterministic supply of Bitcoins. And that's really how it maintains this fixed supply. How it maintains this deterministic issuance schedule. So it's a crucially important part to Bitcoin's monetary policy, is this difficulty adjustment. So for commodities like industrial metals or oil, there's a market equilibrium. When the demand goes up, the price will go up. And what this creates is an incentive to increase production. And you start spinning up more mines, you start adding capacity to existing mines, and effectively you boost up the supply to bring the price back down to market equilibrium. How many more miners can come online to equalize that price? Likewise, when you get a price drop, the incentive is there to decrease production, downscale some of your operations. The supply then gets more constrained, and then the price comes back to that market equilibrium. Now with Bitcoin, you've got a difficulty adjustment that restricts the issuance to a deterministic schedule. And therefore, this dynamic actually no longer applies. Even if you increase your production or you decrease your production, the overall Bitcoin that's mined remains deterministic. It remains the same. So the supply is actually inelastic, and therefore your price can only move with demand. When your demand goes down, your price will follow. When your demand goes up, your price will follow, because your supply side is effectively deterministic irrespective of what's going on. Even if you had one miner on the network, the issuance would be exactly the same as it is today. And you can see here, this is the mapping out. So you can see in the orange is the actual inflation rate. And you can see the difficulty and the price there, both in the uptrend. And whilst there's still a lot of noise in the annual inflation rate, this is because I'm taking daily data from Coinmetrics. There is some variation. Hash rate, because it adjusts every 14 days, there's still some fluctuation between these things. Hash rate does vary and it does fluctuate on a day-by-day basis. But you can very clearly see the halving events. You can very clearly see the near linear or the gradually downtrend of the inflation rate. So the issuance schedule is kept very, 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 very clean by the difficulty adjustment. Even though hash rate has been in a constant uptrend, price has been going up, issuance remains deterministic. So the miners are rewarded with the newly created BTC plus any transaction fees in the block that they just confirmed. And Bitcoin's model is to dedicate 100% of this block reward to miners to pay for security. Bitcoin optimizes for secure and immutable ledger. There's lots of other networks out there that change this, change the way that their proof of work distributes coins, but Bitcoin has opted 100% to optimize for security. And for a miner, we need to remember that their income is denominated in BTC, so they are subject to the impacts of volatility and price movements, but their costs are denominated in USD, and that's the capex for actually buying the ASICs, and the operational expenses such as electricity and rent and land tax and all those things. So their costs are in USD, but the income that they've got coming in is in BTC. So they have a very, very complex and interesting dynamic that they need to deal with to remain profitable and in business. It's a very, very serious business being a miner. It's there's lots of risks involved, and they commit a significant amount of capital to this thing. So it's actually very important that we understand what their economic model is. So we can understand what this economic model is by looking at this as a security spend. How much do we, as Bitcoin holders, spend on security in order to maintain the Bitcoin truth machine? And you can think of that as how much does it cost to wind back the Bitcoin truth. So as the demand for Bitcoin increases, more security providers can be sustained by the subsidy. It means that as price goes up, it just means that more providers can join the network and still be supported by that security subsidy. And the total miner income is then counterbalanced by the block reward halvings and the variability of transaction fees. And you may hear this play out where people worry about the security budget in 10, 15, 20, 50 years' time. As the block rewards go down by half each 4 years, your transaction fees are going to change, and this is all going to be, as I said before, it's all going to depend on demand for the network. So if demand for the network continues to grow, there's every reason to believe that price will continue to expand, and therefore it will continue to be able to support at least the miners we have today, most likely more, and this dynamic will evolve in time. And that's where you have this balance between block reward, transaction fees, and the cost of hardware and the cost of electricity and OPEX and various other things that come under that umbrella. So there's other factors like Lightning Network, Liquid, crypto banks that are all going to change the way that transaction fees function. But again, I think the important thing to take away here is that Bitcoin's security is actually fundamentally driven by price, which is fundamentally driven by demand because the supply is inelastic. So you can actually relate the demand for Bitcoin directly to its security model using that parallel. So I've run some numbers looking at the actual miner income, what kind of fee networks you've got coming in. I've classed this into the different phases of Bitcoin's cycle. We tend to get bull-bear cycles, 2 to 3 years in length. And you can see here that the miner income has gone from 300 million back in the early days. It's now at $3 billion as of year to date. And last year through the bear market, it was almost $5.5 billion in terms of total miner income. As a percentage of that, the fees have gone from low 0.5%. Through the bull market, we moved up to 15%. And then through the bear market, and even now, year to date, so we're not even talking about a whole year yet, we're already at almost 4 to 5%. So 4 to 5% of this miner income is actually coming from fees. And you can see that over time, this is actually increasing, which is improving the chances that we're going to have a sustainable security budget into the future. So then I compare it to the economic throughput. How much transaction volume does Bitcoin actually settle versus how many dollars the network spends on security? And you can see that the economic throughput are orders of magnitude larger than what we're spending on security. We're talking about $3 billion year to date on security, and yet it's putting through $1.27 trillion worth of value. So there's just orders of magnitude more value flowing through the network. So the demand is clearly very, very high. And you can then look at the economic density, which is how many dollars are settled, how many dollars are transacted over the network versus how much we pay for security. And you can see that the economic density is actually increasing with time. In the early days, we were down around 200. We're now pushing up towards 300, 400. And in that bull market, $800 per dollar paid for security. So really, if you're spending $1 on security for every $415 that are transferred in the world's most immutable ledger, it's starting to look fairly efficient and a fairly promising system. So this is getting real financial and looking at some of these plots. You can see the amount of value that it's settling in the white line. You're looking at, under $1 billion back in 2014. You can see the significant run up through 2016, 17, and then into 18. Bearing in mind that 2018 was the start of that bear market, and overall we still settled $5.5 billion in miner income, and you can see that the fees. The floor for the fees, even through this bear market here and year to date, is increasing. It's much higher than it was back here. And even in an early bull market in 2019, we're already getting up above what we had for 2017. So the network is continuing to settle a lot of money and pay the miners a fair wage for their work. So an overall view of the Bitcoin economic over time. This is all data source from Coinmetrics. This is looking at the cumulative sum. So we can see here that in the white at the top, Bitcoin overall has just passed $7 trillion in total value that's been sent over the network, which is quite remarkable. That represents a market cap of 180 billion, realized cap of 100 billion. So for people storing wealth in Bitcoin, it's 100 billion. And you can see that there's, again, an order of magnitude more value being transferred than there is being market priced. So you could argue that this is potentially undervalued in terms of what it's currently processing. For all of that system, we're paying 14 billion in terms of total miner revenue, and that's including block reward and fees. So considering we're transferring $7 trillion and we've only spent 14 billion, it's a fairly good deal. And that fee revenue is then coming up to $1 billion. So the fees so far, excluding block rewards, have paid about almost $1 billion. So it gives you an idea of the scale of numbers that we're talking about here. So this is then plotting up a bit of an idea on how much value do we get per dollar that we spend on security. So in the green, we're looking at the amount of value that gets transferred. So it's that $7 trillion divided by the miner revenue. And effectively, for every dollar that we spend on security, we're transferring on average about $500. So again, a fairly robust and efficient system. In the blue, so the realized cap is a measure of how much wealth people have stored, because if you buy a Bitcoin, you transfer it to your wallet, that will remain at the current price when you transferred it. So it's kind of a representation of how much you saved. So this is actually an even stronger metric. This is saying that we pay $7 in security. For every dollar that gets saved, we're paying $7 in security. So again, it's a fairly robust metric. And then for all of this, if you were to aggregate all of this information, so the yellow line is in fees, even at the peak through 2017, 2018, we were still only paying 0.015% fees on aggregate. So it's very, very hard to find a bank or any legacy system that will transact your money for the case of $500 per dollar spent at a fee of 0.015%. So overall, Bitcoin is proving to be an extremely efficient and efficient use of capital resources at this point. And we'll come back to whether it's efficient on the sense of energy later on in the module. So you can see here, this is mapping out again the realized cap. So you can see here that this is how much value people are storing in Bitcoin. And you can see these price floors. So effectively, we're saving, back in the early days, $1.80 per dollar paid. It then moved through the 2015 bear market as the price floor, saving about $3 per dollar paid. And now we're moving up into that $6.5 paid. And you can see this constant increasing of the floors through these bear markets. And what this is showing is that the protocol is becoming increasingly efficient at saving our money for a reduced security spend. So overall, the protocol is getting more efficient at storing safely our money, and we continue to see that we're not getting attack vectors that are really getting through that security spend. Many would say that we're actually spending too much. We're overspending on security at the moment, but this gives you a bit of an idea of just how secure that actually is. So if we combine all of these concepts, we're looking at BTC rewards are only mined after provable work is actually expended. The difficulty adjustment keeps the issuance deterministic with a dynamic hash rate. The security subsidy is a balance between the halving block rewards and the variability of fees. The hardware will eventually approach some kind of optimal performance. We've seen this as ASICs have come online. And eventually there's physical limits on chip sizes and how much can actually be processed on a single piece of silicon. So there's an optimal performance where ASICs will eventually stop being deprecated. And over time, you will end up with a ASICs that may last 10, 15 years worth of operational history. So it becomes a much long-term efficient system. And as a result, the absolute hash rate is actually less important than the electricity consumption when we measure network security. If we assume that an attacker can get access to the latest ASICs, it doesn't really matter what the actual hash rate is. What matters is how much electricity is being consumed on the friendly side compared to how much is being consumed by the attacking side. That's really what it comes down to. And we assume here that they can rent the best and baddest ASIC hardware that's on the market. So we've said before that energy is a fundamental commodity of the universe. It's neither created or destroyed, it just changes form. So Bitcoin security and finality are really a representation of the amount of energy that was consumed to protect the Bitcoin truth machine. So we can appreciate Bitcoin as probably the first true form of energy money, where we actually price or we can develop some kind of model based on the fundamental value of Bitcoin, using that basis that it is actually a transmuted form of energy, where electricity is transmuted into BTC. And this is really the first time. There's been lots of papers and ideas and concepts about energy money over history, but this is the first time that we've had something that really does fit that brief of a potential representation of energy as a currency. So a profitable miner or an attacker, they both have to consume more electricity than their opposing counterpart in order to be successful. So it assumes that everyone uses the most efficient ASICs on the market. And we look at the aggregate miner energy consumption as always following the BTC price. So this is because the miner's income is denominated in BTC and their costs are in USD. And when the price goes up, there's more room for the subsidy to have more people securing the network. So more miners will enter the fold. And likewise, when price goes down, you're going to have more miners that leave the network because they can't afford to remain operational. And you get this case where the marginal cost of being a miner is always equal to the marginal revenue. This is the equilibrium we'll always approach. And the difficulty adjustment ensures that the system always tends towards this opportunity. And what you end up with is Bitcoin being a fundamental price for that cost of electricity, because it will always tend towards that equilibrium point. If price remains static, you're going to have the difficulty adjustment then reach some kind of plateau. And miners will eventually go out of business if they are spending more than they're making. So the current BTC price has a very, very strong link towards the cost associated with actual production of mining. And this is where we get this concept of energy money from. So we'll talk through some of the the nature of Bitcoin mining as it stands today and why these things occur. So miners are incentivized to seek the cheapest electricity that they can. It results in a geographically and jurisdictionally diverse miners. There's concentrations in certain countries like China and parts of the US and Canada, but it does result in a somewhat apolitical system, because even if all the miners in China went down, the difficulty adjustment will then bring it down to a level that's sustained by all of the existing miners in the network, the ones that remain. Renewable sources are consistently the cheapest sources of electricity, and there's a very, very high movement of Bitcoin miners towards that renewable energy, specifically in hydro, has seen a lot of uptake because it is the cheapest form. There's an opportunity to capture wasted or untapped energy, things like methane flaring, and people can effectively mine remote geothermal energy where they may not have the power grid to transport that electricity, but if they were mining Bitcoin, they could effectively export that power by selling the Bitcoin, and all they would need is an internet connection. They wouldn't need all the electrical infrastructure to transport that and make money off that geothermal power. So it actually captures untapped energy sources that previously there was no feasible way to extract that energy. And in the future, there's going to be innovative second order effects like home heating, pool heating, all sorts of other things that these miners, when they generate heat, we can start using that heat and putting it to a second order effect. So below is just a quick snapshot of how many Bitcoin networks can be run by the world's hydro plants. We can run 64 of them. Biofuels and waste, we can run 9 protocols, and solar and wind, some 21 Bitcoins. And there was a CoinShares report released in June this year that was indicating about 75% of Bitcoin mining, and I believe this was a lower bound estimate, is currently operating off renewable sources. So the argument against Bitcoin as a wasteful consumption of energy, there's a lot of nuance to that, and the debate remains to be seen whether that has any legs at all. I'm of the opinion that Bitcoin is really incentivizing the development of cheap electrical sources, and it's creating new and innovative ways for us to capture otherwise wasted energy. So it really is the buyer of last resort, which we'll get to. There's benefits for the electricity grids as well. So Bitcoin provides a base load power demand. Miners need a constant stream of electricity. There's lots of areas of the world where various power plants have issues with peak trough demand. Because miners have a constant base load demand, they can effectively request long-term energy contracts. You end up with a predictability both on the supply and the demand side. And in many cases, the renewable sources, hydro plants, different power plants that are very, very costly to spin up and down, because they have that constant demand, they can actually set up a system where during peak period, they can keep the price for the public static because they've actually made their profit off the Bitcoin miners. And then during trough periods, Bitcoin miners have had agreements where they can actually wind down their power consumption so that it gets passed on to onto the public. So the public actually have a stable energy price, whilst the Bitcoin miner actually absorbs the volatility of up and down because they provide that base load. And this is where we get to the concept of an electricity buyer of last resort. Bitcoin is always there to actually absorb that last piece of electricity and capture all these different disparate energy sources that are otherwise going to waste. And because the proof of work roots the blockchain security and consensus laws into the laws of physics, it's impossible to spoof the provable work, and this is where you get the unforgeable costliness. Other than buying it, in which case you're trading your time and your money for BTC, the only other way to acquire BTC is by committing your hash power and committing your work, your capital, and the electricity energy consumption to the mining operation. So there is just no other way that you can acquire it aside from trading your time for somebody else. And physics limits where ASIC chips can actually get to. So over time, we're going to see reduced obsolescence long term. ASICs will reach a point of where you can actually, miners can buy these things and reliably use them for 10, 15-year windows, potentially more as things become increasingly idealized. So in the early days, yes, there's going to be a lot of hardware wastage, simply because technology evolves, chip sizes get smaller, research and development progresses. But over time, we are going to reach an equilibrium point where the capex becomes the smallest part of the miner's equation, and it actually becomes purely based on OPEX or dominated by OPEX. So therefore, you reach an equilibrium point where the cost per kilowatt of energy starts to move towards that BTC income, and that's where you get that marginal cost starts to equate to marginal revenue. And you can see here just a plot showing energy usage versus time of the various mining hardware, and you can see that it is most definitely trending down. We're getting increasing efficiency over time. So we can now establish an energy density. So we said before we had an economic density, which is how much is settled or how much is saved per dollar spent on security. Now we can look at what is the energy density. How many kilowatt hours does it cost to actually produce a transaction or settle a particular transaction or save money? And when we plot this out and look at it in terms of per kilowatt hour, for every kilowatt hour that we spend on security, Bitcoin settles $33 and it secures $840, which is coming from the realized cap. So if we think about this, transactions are relatively cheap. We're doing lots of transactions, 7 trillion of them for the same security budget. So per kilowatt hour, we're actually spending It's relatively efficient. We're talking about an average cost of 5 cents per kilowatt hour. If you're spending 5 cents and you're settling $33, and what's I think most important is for every kilowatt hour, it's securing $840 worth of people's wealth. And for me, if you're securing $840 with 5 cents worth of energy, it's an extremely efficient machine. And I think that's something that's truly remarkable considering it's free software. So that's an interesting perspective on this thing as to how much energy it actually consumes. I would argue it's one of the most efficient systems that we have globally when you look at it in this context, particularly in its early days. So we'll start moving into the last phases of this module, looking at how we can use this information and this knowledge to build some kind of fundamental pricing model, and give you a bit of an idea about how how we can look for macro shifts in the market, where are the market bottoms and market movements, expansions. So Bitcoin mining profitability is a function of price and energy. The difficulty adjustment always approaches that mining equilibrium. So it's reasonable to conclude that price actually leads hash rate, not the other way around. And this comes back to what we were saying, where as the price goes up, miner's income is in BTC, therefore the total income is increased, and therefore it can support more miners because the electricity costs remain in USD terms, right? So they remain, let's argue, static, whilst it can actually support more miners coming on board because the income is now higher. And miners must be long-term investors in order to survive. Those that are not long-term investors and don't think about the 10, 15, 50-year venture, they really just won't survive in the mix. And therefore, for us, understanding their entry and their exit becomes a very, very important macro and valuable signal, because the miners are the most important participants in the Bitcoin network. When they are entering the market and when they're exiting the market, considering their long-term view, it's a valuable signal for us to keep an eye on this thing. So as Bitcoin goes through bull and bear cycles, price will experience volatility and you get significant booms and busts. And what this will manifest in for difficulty is a period of steepening of the difficulty curve, where new miners come online, the hash rate increases, and therefore the difficulty adjustment has to go up. Or you get a flattening or reversal of the difficulty curve when you get minor capitulation at the bottom of bear markets. So what we can do is take a series of moving averages of the difficulty rate, and we can establish the Bitcoin difficulty ribbon. And a huge credit to Willy Woo, who originally developed this metric. It's quite an interesting study to look at. So this is taken from Willy's site, woobull.com. This is the difficulty ribbon, so you can see the different lines plotting up, various moving averages: 200-day, 128, 90, 60, so on down to 9-day. Obviously, the 9-day moves the fastest, the 200-day moves the slowest. And what we see here is during periods of price expansion, where the security subsidy can support an increasing number of miners while still maintaining as the difficulty adjustment goes up, you get an expansion of the ribbons. They start to spread out. The 9-day starts to move up higher. The 200 days obviously are much slower, but higher conviction signal. And then once you move into normally at the bottom of a bearish market, it becomes a compression where miners are now, the weakest miners start to capitulate. Their long-term view has fallen apart. Their current cost exceeds their revenue. You get to a certain point where you turn off some of your machines, and if you keep going, eventually you have to turn off all of your machines to remain, rather than just burning money. And because the hash rate now drops at the bottom of bear markets, you end up with a squeezing and a compression of that difficulty ribbon. And historically, this is shown to be an extremely beneficial time to get in. And when you combine this with the realized cap, you start to get a very high conviction signal as to when you should actually be thinking about whether there's a bottom coming in. You can see each of these occasions it captured the bottom of the market. So if we zoom in to a couple of these, we'll go sequentially 2011 to 2012. You can see here the 200-day moving average breaking up through and actually crossing over, and you can see that this correlated strongly with that capitulation move where miners are effectively capping out and leaving the market. and it has historically been a strong buy signal. We see it again with the 2013, 2015. We didn't quite get the 200-day cross as we had for the earlier market, but we certainly got that very, very distinct flattening and compression of that curve through this zone. So again, through this bearish period, through the capitulation phase, an opportune time to be thinking about whether there's an entry at play. And the one that we're all most familiar with, fresh in our minds, you can see we again got the 200-day moving average cross for the 2018 or the 2019 end of bear. This would have actually still been pretty close to 2018. But you can see that expanded range of the difficulty ribbon, and then that very, very distinct flattening to horizontal and compression of all of those difficulty lines. So to kind of close out what the market dynamics that are going on here. So during a bull market, your security subsidy is increasing. It's able to support more miners. More and more miners are actually able to be supported by that subsidy. The difficulty ribbon bands expand, and you get a distinct uptrend in both price and the difficulty ribbon. And in terms of what the miners are thinking at this point in time, new miners are now able to come online. So there's new, fresh operations coming live. Existing miners are now able to expand and use their leverage and take on debt and build up increasing larger farms. They will actually end up selling less coins because they're going to hang on to coins specifically around the halving event, knowing that price is likely to rise. So what happens is miners actually start accumulating coins themselves. They mine and they sell less because they don't need to sell as many to cover their costs. And this actually ends up constraining supply. And this is a very, very important dynamic to be aware of because miners are where they are the source of income. So understanding when their supply constraint comes in, that will eventually drive price up. And then you move into the bear market phase. The security subsidy starts to decrease. It's able to support fewer miners. The bands contract. You end up with a sideways squeeze of all those of the difficulty adjustment. And miners now have to sell more coins to cover the same cost. So that means that the sell pressure actually starts to increase. And you couple this with the fact that a lot of the coins that they've been hodling through the bull market are now going to come into sell pressure. And this is a large reason why we see such violent moves. We see a lot of sell pressure in the early bear market, and then particularly down towards capitulation. The news is always grim. There's photos of ASICs being hoiked out the window. Weak miners start to capitulate, and the more miners leave the market, the strong miners who remain continue to gain share in the hash rate. So their income relative to the rest of the market increases. So the strong miners then reach that equilibrium point when they're starting to make money. They're back above water. As weak miners drop off, the strong miners have a higher share. And eventually they start hodling coins because they're back above water. They're selling less. And then you get this transition back into a bull market. And this is, again, just pure supply-demand dynamics playing out. So for the very last piece, we'll be able to keep this thing under an hour. For the last piece of this module, we'll look at the regression analysis that was done by Hans Haag. So we've seen the mechanics of miner profitability, and there's a clear link between hash rate and difficulty, interchangeable, and price. As with many features of Bitcoin, they're best understood in a logarithmic space due to Bitcoin's exponential rise. Hard pressed finding an asset that you need to look at this thing and log in every single regard, but this is one of them. So after the work of Haag in last year, we can perform a linear regression analysis to determine whether a formal relationship actually exists, taking the log of the market cap and the log of the difficulty. And for those statisticians in there, you may get some enjoyment out of this. So this plot here in the top left is then showing that plot. You can see in the blue line is that actual connection between the two of log difficulty and log market cap. You can see there's a linear trend there at the very least from a visual perspective. And then with an R-squared of 96.5, so it indicates that there's a strong chance that there's a relationship, or it's a low chance of it just being coincidence. And then if we can use that equation, so that Y there is going to be log market cap times your 4.81 times log difficulty, and then plus your constant, you get this blue line. Sorry, not blue line, the green line. And what this is kind of representative of is based on the amount of hash rate that's going into the network, what does the valuation of Bitcoin really look like? All right, are we at a fairly priced level? You can see this zone through here where it actually matched in fairly well with the realized cap. You can see it managed to basically act as a level of support for the realized cap on the way up through the 2013 move. During a lot of 2015, we were underwater underneath this, arguably fair market value. And you can really see here where you get this period where the green line or the difficulty regression line is above price, that it's normally a period of accumulation. There's an opportunity there. When price or market cap then moves up above your green fair value line, potentially a period of time where not necessarily a sell signal, but most certainly a stronger hodl than a sell. Accumulation at your peril. Up through here again, where the green line is up above your market cap. Great period of time for accumulation. Once it moves above that, it goes into a phase of hold and then potentially sell at the top. So I wouldn't argue that it's necessarily a metric that you would use for choosing your entry and exit points. It's what you can use to look for value positions. When is the fundamental mining perspective potentially undervalued relative to the current market cap? So it's just another tool in the tool belt of analytical methods to look for value in the network. And you can see here that we're sitting at a miner's revenue, call it, or miner's value of about $7,500. So we are sitting up above that price. Is it actually a hold position? Yeah, maybe refer back to some of my earlier modules on the NVT, RVT. May give you a bit more insight here, but it remains to be seen where price goes from here. So to close this thing out, we'll look at the evolution of the mining industry, where this thing is all heading. There's a number of things that's going to evolve for the industry. I think one of the most important ones is going to be derivatives like options and futures to really help them hedge risk. If you're a miner and you've got a continuous stream of BTC coming in, selling call options, $2,000, $3,000, $5,000 up above the price, you either pocket the premium if it doesn't go off, or you sell Bitcoin at a higher price. So it's excellent, and likewise in a bearish market, selling puts and things. There's a lot more opportunity for both speculators, traders, and miners. It gives them a lot more opportunities to hedge their risk. And if you were to, the challenge with miners is that they actually need to hedge difficulty, which, as we said before, has been in a constant uptrend. So hedging difficulty is not a business that many people would like to be in, because the thing goes in one direction. We're going to get increased professionalization of the industry. Miners who just build a warehouse and dump ASICs in there and hope for the best are not going to compete with miners who air condition the things, keep them at a constant temperature, service them every 5 weeks or 2 months or whatever their sequence is, and look after their equipment. So we're going to see a lot more professional industries come into this, a lot more optimization of energy, capitalizing on disparate energy sources and renewables, and optimization of ASICs and physical chip size limits will eventually get reached. There could be some, who knows what comes ahead. Technology is exponential, but we will reach some physical chip limitation where more efficiencies come from not having to deprecate machines as frequently as they probably do at this early stage. So here's I would argue, a subset of the resources that are worth keeping an eye on. As always, there's an amazing pool of open source information out there. I kind of hope that I've consolidated some of these papers and ideas and concepts into this module. Check any of these papers out and these studies, because there's a lot of value out there that's worth hanging on to. And that's it. So we managed to sneak it in. 58 minutes I've got, so just under an hour. Thanks all for your time. If you've got any questions or thoughts, comments, complaints, tomatoes, whatever it is you want to throw at me, feel free to go. I'm happy to stick around for a couple of minutes and answer some questions that you guys might have. So I hope you got a lot out of it. I don't know what the next module is going to be on. I've got a couple of ideas, but it could be a bit of a basket of various things like Mayer multiples and Bitcoin momentum. I've been thinking about doing something on hype cycle using hodl waves and various other metrics. But quite frankly, there's more metrics being studied and developed in this space than anything else. then, it's happening faster than I can study them. So there's no shortage of content. Okay, so Ricky, you're asking, in other words, China with more miners still cannot attack the network as it would take more than their accumulated miner pool to attack the network. So I think my understanding of China is that they currently have some, I think, don't hold me to it, I think it's about 60% of the total hash rate. I think it's about 60%. You need more than 51% to reorg anything without spending an absolute fortune. You need way more than 51% to successfully attack a block that has already been confirmed. Reorgs within the current block or the tip of the blockchain is not uncommon. There's miners and orphan blocks and things that happen all the time. But look, in order for China to genuinely attack Bitcoin, there is a lot of moving parts that have to happen. If you assume that just, wish in place they were able to capture every single one of their miners and direct their hash power, the network would realize this is, it's the most transparent network on Earth. So we can see everything that's going on. People would understand. Friendly miners would understand. There's a lot that could be done. And even then, it would be an extraordinarily expensive attack. And I think it's unlikely to have. I think the threat is there. Everything is a non-zero risk, but I don't believe that it's something that is critical importance because, let's face it, the game theory is there. If you're a friendly miner, you'll make a hell of a lot more than attacking it. That's because I'm neither bald, but I am young. Whether I have wispy hair or not is a different question, Julio. Retail mining rigs for Bitcoin, I think that ship has sailed, long gone. It's almost entirely industrialized. I don't think there's any. There's very few areas in the world where it's profitable. However, if you choose to spin up a miner, and again, this is the beauty of distributed proof of work. If you spin up a miner, no one's going to kick you off. Cannot be done. So, I saw an interesting post the other day that was saying, if the let's picture long term where the block rate halvings have taken the security subsidy down heavily. It's all about transaction fees. It may be that it actually no longer can support industrial mining players, and it could actually revert back to you and I sitting there with a couple of machines plugging away, or our heaters plugging away, mining Bitcoin profitably. So who knows what the future dynamics look like. My current perspective is that the security for Bitcoin, as Dan Held would like to say, is just fine. Peter, yes, Realize Cap, by far. Realize Cap is an excellent source for understanding the accumulation phase. Combining the Realize Cap with the NVT and RVT are an extremely high conviction and strong way to pick the bottom. The mining difficulty ribbon is obviously another one that shows that high conviction. And what you want to do is you want to layer as many of these high conviction signals on top of each other to develop your entry thesis. You could sit there and wait for 4 of these things to line up, and you would be entering with a fairly high confidence that it's a good place to be. So layer your responses and layer your tools. I think that's it, guys. Thank you all for your time. Really appreciate it. And stay tuned for the next one. No idea what it will be, but thanks for your time. Cheers.